As you may know, the RRSP deadline for the 2024 tax year is March 3rd, 2025. In today's video, I'm going to explain 3 scenarios where you may want to consider contributing before the deadline. But before we get into that, let's talk about why this deadline exists and what the purpose is. How the deadline works is that in the first 60 days of every year, you can contribute to your RRSP. And when you file for your taxes, you can decide whether or not any money you put in the first 60 days is going to be deducted from the previous tax year or the current year. And it's up to you. You can actually decide to just do it all for the current year, or you can decide to put a portion or all of that towards 2024's taxes if, let's say, you're doing this in 2025. So the first scenario where it may make sense to actually contribute before the deadline is if you expect to make significantly less income this year. Look, a lot of Canadians are struggling right now. There's a lot of layoffs happening. If anyone is in between jobs and they feel that they may have a lower income this year, it might make sense to actually contribute before the deadline. The reason is because if you make a lot more last year, you may be in a significantly higher tax bracket. And if you're going to be in a lower bracket this year, you actually might want to make a lesser or even a zero contribution to your RRSP. If you do contribute before that first 60 days, though, you can designate those contributions for last year's taxes, therefore getting a higher tax return, and it's just going to be more tax efficient and more money in your pocket. Now, the second scenario where you may want to consider contributing to RRSPs before the deadline is if last year you're in a significantly higher tax bracket than the next tax bracket down. Now, that might sound a little bit confusing, right? And it is. So let's explain this and understand what that means. What we have in Canada is we have what's called a progressive tax system. So every time we make an extra dollar of income, it may fall within the same tax bracket, or it may bump you up to a higher tax bracket. But let's say, for example, if you live in British Columbia, we take a look at some of the updated numbers, the approximate tax bracket that puts you from 32% marginal up to about 38% marginal, which is a 6% jump, give or take, which is a pretty significant tax hike. It's any income earned above $111,700. So if you, for example, made $112,000, the first $111,700 would be taxed at a lower rate than the $300 that you made up to the $112,000. And of course, if you made, say, $120,000, then from $111,700 to $120,000, that extra chunk is going to get taxed at about 38%, whereas below that, you're at 32%. So in that scenario, if you aren't really taking advantage of that 38% deduction, you might want to consider bringing your tax bracket down right to that threshold, because any money you put in below that tax bracket, it's not going to give you as high of a tax return, and you might not even want to put it in your RRSP. So that's another scenario, is if you're in a significantly higher tax bracket than the next bracket down from that. And the third scenario where you may want to consider using an RRSP before the deadline is if you actually are planning to buy a property this year. The reason this is important is because if you are going to put a down payment of $100,000, $150,000, $200,000 to buy a property this year, a lot of young people in Canada now are getting help from their parents. So even if the money isn't in their hands yet, if it's gifted money, it could be given to you, and you could use that to put into your RRSP, deducting your taxes from last year, and now you can take a significant amount out of the RRSP and use it for your down payment. Last year, the government increased the homebuyers plan limit from $35,000 up to $60,000 that you can withdraw. So that's a significant increase. And if you haven't fully invested in your RRSP and you don't have that $60,000 there yet, you may want to consider putting that in for last year's taxes. Now, there's also the FHSA. Make sure that you're going to use that account and maximize it, because it's totally tax-free and you don't have to put money back into it later like you do with the RRSP. But that's another thing that you may want to consider, because you can use both the homebuyers plan and the FHSA when you're putting money into your down payment and taking it out tax-free. Tons and tons of value when you're looking at how to utilize these accounts for buying property. So that may be something you want to consider if you're buying a property this year and you're making a big down payment. That's it for the video, guys. If you like the content, please leave a comment, please like, subscribe, and I hope to see you in the next video.